What is basis risk when hedging with commodity futures? Imagine trying to protect yourself from price swings in a commodity, but the protection doesn't quite match what actually happens in the market. That's what basis risk is all about. When you use futures contracts to hedge, you want the futures price to move exactly with the spot price of the commodity you're dealing with. But in reality, they often don't move in perfect harmony. The difference between the spot price and the futures price is called the basis, and it can change over time. If the basis shifts unexpectedly, your hedge might not work as planned, and you could face surprises. The basis is calculated by subtracting the futures price from the spot price. If the basis is stable, your hedge will be more effective. But if it fluctuates, you might still lose money even if your market prediction was correct. Several factors cause this fluctuation. For example, the quality or grade of the physical commodity might not match the standard specifications of the futures contract. If you are a farmer selling a specific crop, but the futures contract is based on a different quality, the basis can vary. Timing is another issue. If the futures contract expires before you sell or buy the commodity, price changes in that period can cause the basis to shift. Location also matters. If your physical commodity is stored in one region but the futures contract is for delivery in another, transportation costs and regional supply and demand differences can affect the basis. External market conditions like weather events, supply disruptions, or sudden shifts in demand can also cause the spot and futures prices to diverge unexpectedly. For anyone involved in commodity investing or production, understanding basis risk is key. It helps you choose the right futures contracts and delivery months that best match your physical exposure. For example, farmers might hedge their crop sales with futures, but if the crop quality or delivery timing doesn't match the contract, the hedge won't be perfect. Energy companies also hedge fuel prices, but regional price differences and timing mismatches can cause basis risk. In essence, basis risk is the chance that your futures hedge won't perfectly offset the actual price changes of the physical commodity. It's a normal part of using futures and derivatives for hedging. Recognizing and managing this risk allows investors and producers to better control their price exposure. By monitoring how the basis behaves and choosing contracts carefully, you can reduce surprises and make your hedging strategy more effective.